But then I stumbled on this post by Northman Trader, and he says the value line of geometric index, the equal weight S&P, was leading during the January rally. During this rally, it has been lagging big time. XVG lagging was a big warning sign during the January 2022 top. What is he talking about here? He's making a comparison about the SPX, the S&P 500, with the XVG, which is the equal weight S&P 500. Usually, the performance between the two is aligned. We don't see massive gaps. We've seen one during the top of 22, and now we're seeing one yet again. And by the way, we have seen one, you guessed it, during the last bear market rally in the summer. This is what the retail mom and pops and the zombies you guys watch on TV and not paying attention to. The false signals. Let's dig deep here. I'm using the SPX as you can see in blue, and then the RSP in orange. This is the equal weight SPX. There is a massive and noticeable gap here, and the gap widened. Pay attention now. The gap widened in the aftermath of the collapse of Silicon Valley Bank, which is, the market believes right now, the best thing that ever happened to them. At least the bulls think so. If this gap were to close, the SPX should go down by more than 4% and lose the 4,000 mark. That is, of course, assuming the RSP stays flattish, which is not going to happen. It's going to go down too. So the decline in the SPX could be more than 4% to close this gap of outperformance. Then I looked into the Qs versus the NDXC, the equal weight. We see the same phenomenon. The Qs outperforming equal weight by about 2.25%. What is behind the gap? Forget about the Qs. Let's talk about the SPX and equal weight S&P. What is behind the outperformance? Well, we have to dig deep and do the forensics here. When we look at the different sectors of the stock market, what do we see? The overall theme is the majority of sectors of the stock market are actually negative or flattish. Yet we have three sectors responsible for the outperformance so far, and that is the XLK, technology, the XLY, consumer cyclicals, and the XHB, home builders. And go to March 13th, you can see that on the chart. It used to be a more equal rally with participation from the XRT and the XME and even biotech, the XBI. But then, in the aftermath of SVB's collapse, the majority of sectors actually went negative, while the outperformance by the XHB, XLY, and XLK accelerated and opened the gap with the rest of the market. So now we know that these three sectors are responsible for the gap between the SPX and equal weight S&P. Well, let's look at we know the XHB is home builders, a lot of them Lennar, DH, Horton, and the index is more equal weighted with no outliers one way or the other. We know why the XHB has been moving higher. The assumption is since the beginning of the year, but most importantly since the collapse of Silicon Valley Bank, is all yields, bond yields will go down because the Fed is getting closer and closer to peak rate hikes. We've been talking about peak rate hikes since last summer. And it never happened. The Fed continues to raise rates higher and higher and higher. But for now, the XHB looks at bond yields going down and says, okay, that is the permission to rally. Let's concentrate on the XLK and the XLY. When we look at the composition of the XLK, it sticks out that Apple and Microsoft compose about 40% plus of the XLK. Nvidia is about 6.5%. Sure, Nvidia is at a massive rally year to date, but Nvidia is negligible in the grand scheme of things. It is all about Apple and Microsoft. Okay, so we now know we have to look at Apple and Microsoft. What else? What about the XLY? The two largest components of the XLY, Amazon with about 23%, and then Tesla with about 15.5%. Well, Tesla's already breaking down. We know the story, the price wars. So Tesla's going to go down, no doubt about it. But Amazon is what we should be looking at here. When we put it all together, Apple, Amazon, Microsoft, Apple in white, Amazon in blue, Microsoft in orange. The year-to-date performance. We can see that Apple is responsible for the majority of the rally by far. But these three names, single-handedly, I can say that comfortably, single-handedly, behind the market rally year to date. Now, I've been through a lot of market bottoms and the beginning of bull markets, be it 09, be it 2020, and the dot-com. I've never seen a beginning of a bull market rally that is not inclusive. It is only led by a handful of names. Sure, in the beginning, some names lead and then others start to catch up. This is not what we're seeing here. The majority of the performance, as you can see in the year-to-date heat map, the ETFs, the US large caps, growth ETFs are responsible for the rally. Small caps are flattish, mid caps are flattish, flattish value with a little bit of gains, but that's it. The vast majority of gains year to date in this so-called bull market that we're seeing right now are led by US large caps, Apple, Microsoft, and Amazon. You can talk about Nvidia, but again, that's negligible when you compare it against Amazon, Apple, and Microsoft. In any case, when we dig deep, what do we see? The majority of ETFs are flattish for the year, with exception of technology and consumer cyclicals. Which one will go down first? XLK, technology, which is basically Apple, Microsoft, or the SOXX, which is basically Nvidia and chips manufacturers? Or is it going to be the XLY, which is basically Amazon, Tesla? Forget about the XHP home builders for now. This will go down when yields go higher, or when a recession happens. So I'm not worried about the XHB because it is a small component, all in all. I don't know if you guys remember or not, but I made a video earlier this year and I showed you the clip from The Godfather when Tom approaches Michael Corleone in the funeral and says, "You know how they're gonna get at you?"
You know how they're gonna come at you?
In reference to the trap. And if you guys remember, I told you, you know how they're going to get at you and convince you that this is a bull market instead of a bear market rally? I told you in that video it's going to be chips. Chips started rallying ahead of everybody else in the fourth quarter of last year. And if they start to break down, that will be the warning sign. The next thing you know, Apple, Microsoft, Amazon will start to break down too. And there goes the so-called bull market. So my outlook for now is, it's going to be number one, chips, the SOXX or the SMH that will go down first, then the XLK. Then as Amazon goes down, XLY will also go negative for the year. And boom, it's over. You don't need to kill energy. You don't need to kill the XLV. You don't need to kill the XLU, real estate, financials. All of these are either flattish or down. Guess what's happening with chips right now? We got a warning from TSM, if you recall. They got their earnings out and they talked about missing revenues for the first time. And today we got yet another warning from a giant chip manufacturer from the Netherlands, ASML. Look at the order value. The drop is stunning. In the last quarter, it was north of 5 billion euros. Now orders are collapsing. The trend is certainly down. If this continues, we might even match the abysmal numbers from the 2020 recession. It was certainly a chip recession. And oh, by the way, after the bell, we got earnings from LRCX, Lam Research, missing on sales, missing on revenues, all down. What more do you need to see? Maybe this will convince you. Look at the monthly chart of the SMH. You gotta keep in mind, the SMH rallied before the Qs. The SMH bottomed, quote unquote, before the Qs and the SPX. Look at what's going on here month to date. The SMH is actually going down. The RSI was weak to begin with, and it is curling down. So is the MACD. And if this plays out, we have a reverse ABC pattern on hand, which will take the SMH all the way to new lows. Which means if this outlook is right, you gotta short Nvidia with both hands. AI my ass. Not gonna happen. But if the SMH is a leading indicator to the technology cohort, the XLK, and the Qs, look at the monthly chart of the Qs. You gotta remember, the SMH bottomed before the Qs. The SMH appears to be reversing before the Qs. And I'm going to close with this. When we look at BofA Global Fund Manager Survey, re-growth expectations, as we headed to the year, the sentiment was absolutely bearish, extremely bearish. It was the lowest reading ever, lower than October '08. And of course, had the market crashed in the beginning of the year, be it in January or February, it would have been too easy. Everybody been bearish. Everybody been calling a crash. It would have been the easiest call ever. But the market, such as life, doesn't work this way. As I said before, the writer of the story has to make it so hard. He, she, it, they have to test you. If the market crashed, it would have been too easy. So what happened? With the extreme bearish sentiment heading into the year, we got a rally. A lot of bears capitulated. A lot of bulls came out of the woodwork, calling for the beginning of the bull market, the end of the bear market, and sentiment and growth expectations improved. But now they're going down again. The bottom in growth expectations is not here yet. Furthermore, in the same survey, the chart above shows us the overweight percentage when it comes to bonds. And this is the highest overweight positioning since '09, which of course, if you're a bull, you'd look at this and say, but Hey Maverick, March '09, that was the bottom. Does this mean that this is the bottom? Do you have the end of this reading yet? When we look at April 23, do you have the turnaround and managers are becoming less overweight in bonds? The answer is not yet. This reading could spike even higher. And the chart below, on relative basis, the more negative the reading, the more overweight money managers in bonds versus equities. Yet again, this is the highest reading since March '09, which if you're a bull once again, you'd say, hey Maverick, isn't this a sign for the bottom? The bottom is already here. You missed it. But you could have said this back in February. You could have said this back in January. The reading continues to go down and down and down, meaning it's not over yet. Once this reading bottom and we see it moving back higher toward equities, then you know that this is the bottom. But right now, you cannot say that this was the bottom. Not even close. And if anything, we could see more allocation toward bonds versus equities. We could see these columns moving even further down and taking the March '09 reading. That is still within the realm of possibility. And if the outlook is right, that chips are about to break, followed by the big caps, then Amazon, and the rally's over, then money managers will take a lot of money out of these big caps, the so-called safety in Apple. Yeah, right. They're going to take that out and buy even more bonds. It's not over yet. Not even close.